Get off the sidelines and take control of your financial future at www.tackletrading.com. Get in the game.
Hello everybody, this is Coach D with TackleTrading.com coming at you here with just a trading idea. One, let's start out real quick and take a look at what's going on with the E-mini S&P futures. Market responding relatively well to the breakout here. We're seeing it push above. We talked about this yesterday in our coaches show. We talked about the general setup, the pressures. We talked about the ECB meeting this morning, the news, the minutes, the whole 9 yards, and we've got a pretty good day to the upside, really pressuring that resistance. Looking for it to break. We've got the Russell 2000. Let's go look at the Russell. Breaking to the upside, actually popping up above resistance. Pretty solid move here on some typical volume, not into the close yet, but typical volume. Good breakout. We like that. We like to see that. Take a look at the Nasdaq /NQ. Now this, of course, would drop the VIX lower. Typically what we'd see here. And the Nasdaq here pressuring resistance, kind of giving you a little bit of a cup and handle type look. Has some overhead resistance still. And let's look at the Dow YM. And we've got a similar setup, kind of pressuring near-term resistance here at 18,000-ish, 70-ish, pops up, got some overhead resistance, but overall across the board, we're seeing some bullish pressures. Now that being said, while running some scans last night, I came across CF Industries, which has a textbook position trading setup. Can be approached as a swing trade. It can be approached as a longer-term position trade. We could use this as a setup for a delta trade. We could use this as a setup for a theta trade, like a credit spread. Now, when I say textbook setup, what I'm talking about is the general position it's trading in right now and the overall patterns and sequences we see with things like Elliott wave, support, resistance, uptrend. Now, what we see here is the stock price trading down on slowing momentum into a known support resistance zone. So the textbook setup is 280 resistance becoming potentially support down here at 280. The big drop followed by the smaller drop followed by a double bottom trade setup and a W. We've got that W for win forming here. Potential breakout. Now, if you look down at some of the textbook indicators, I've got a MACD set to 8, 17, and 9, a little bit better settings, giving a textbook buy signal down here. So we got that crossover buy signal. And the slowing momentum is going to give you a divergent histogram every time. You're also going to see a divergent stochastic and a buy signal by the stochastic right now. So you got the stochastic I've got set to 10 and 3. So 10 on the %K, 3 on the %D. 10 is the number of days, 3 is the moving average of 10. And it's a good signal, good at giving you signals, but in conjunction with the MACD. You'll notice it gave a buy signal back here, and against the trend, it gives bad signals. Here's a great signal for it to give you a good buy. Over here, it gave a bad sell signal, good sell signal. Hey, 1 out of 3 ain't bad. But that's why they use it in conjunction with a slower indicator like the MACD to keep it from giving you that premature trigger. So that being said, we've got that general setup. And if we look in here, you'll see the moving average crossover portion of this. Earnings isn't until May 6th. The moving averages I've got here are an 8-period exponential and a 21-period exponential, which is just a general crossover system. They'll cross over, but they're not going to cross over until the price is actually popped up and it's well into the move. It's that trigger above resistance that I'd be after. So for me, I would trigger in intraday based off of it trading above 287.50. It's right up there right now. There you can see the W. This is a 1-hour time frame. You can really see the W, and that's the resistance point I would look at as a solid trigger. Now, what I like to do is cross-reference it against the sector and the industry group. Now, I looked this up, and it's the Dow Jones USCX, Specialty Chemical Index, which is already on a tear. If we kind of back out and look at it, it just came off a big support resistance zone, and it's running up. Now here is where I would like to show you how to use the seasonal indicator. Now I'm cautiously bullish. Of course, the market could turn at any time, but cautiously bullish. In the chemical sector index, what I'd like to know is how does it perform on average? So inside Thinkorswim, you can come up to the style, go down to the chart mode, and you can use the seasonality setting, and it'll come in and it'll track the historical setting. It'll track the historical performance. So the green line here represents the index, and then that data falls off, and you can see it's up here much higher price, and compared to its performance. Now the current chart setting on this, so I've got to go look at number of years we're looking at. So over the last 5 years, it has performed well from April, mid-April through May. It's done relatively well through this time of year. I could go add more data and more information to it to get a good feel. If I wanted to, I'd go down to the chart, to the settings here, and I'd include more year, 10 years, 15 years, 20 years. If I went to 10 years daily and looked at that, I'm now sampling even more data. You'll notice the graph shifts a little bit, but it's still showing us general upward movement over April through May. And that's kind of what I'm banking on. Now, if we drop this back out and actually look at the stock itself, it'll maintain those settings. And now what we see here is the graph's really skewed because of the price action. Like the price down here is really low. This stock's trading at newer, higher prices. And so I'd have to actually exclude that data. So what I do is I'll come into that setting and I'll just come in and zoom, but I'll leave that data part out and just get a look at it. And then we might have to scroll forward just a hair to exclude that green data up here. That's what's holding it up. So if I move forward just a hair, boom, there it goes. So what I see here is that from April right through there, mid-April through May, through like first part of May right here, you're seeing an upward movement in price. It gets choppy in May, this particular stock, but the index does well. And coupled with the setup, I'm pretty comfortable with that idea in general. So that's over the last 10 years. You know, I could again drop that setting back out, see how it's done over the last 5 years during a bull market, and just go back to 5 years. How has that been doing? And get a good feel for it. And again, right there from current date, 15th, forward, if I were to zoom in on that, oops, just trying to get that to cooperate, and there it goes. Nice upward movement through part of May. Watch out for a sell-off. So that's where you probably get a good swing pop out of it. Now, if we were to bring in more history and look how it does on average between now and, say, the end of the summer, on average, we're seeing some good performance. So that's where a position would come in. And let's go back into just regular chart setting here. The general pattern I'd expect is a breakout, boom, step 1, retracement, 2, big move, come 3, which would put you towards the end of May, beginning of June. So you get breakout through May, retracement in May. So when it finds its bottom, we look for that to find support and start to run up. Looking for that out there. That's where you get the third wave big run. So we're, general Elliott wave cycle. Now, guaranteed, not a guarantee, void where prohibited, not valid in all states. Past performance does not equal future performance, but this would be a good setup for putting on like a bull put credit spread down below support. If the premiums work out, we could go check and see if the premiums work out. And maybe you look at those shorter term options. Maybe you're looking at some weekly, 16, 23 days, bull put credits down below support, low deltas. There's plenty of premium down in here, plenty of premium, where we could find really decent credit spreads for the next 23 some odd days. And you'll get slightly better premiums right now if you go look at it because of the downward movement in price. So here you can get 31 cents on a $5 spread. Not over the top, but when you're talking about like a $60 strike, several points down with a delta of 0.09, that'll give you a decent roid. You can go be a little bit more aggressive and get a little bit more premium out of that. But general ideas is that this setup, coupled with the probable upward movement in price, a hard support zone at 280, and then the statistical probabilities of it not dipping below, say, 265, 264 between now and that expiration in May, you could have a pretty solid trade just by selling that 260, 265 bull put credit spread. Get a nice little return on that. This is Coach D, TackleTrading.com. Hope to catch you guys in the clubhouse where it looks like we're having a lot of fun, a lot of commentary going on. Love that. And we'll see you in there.
Isn't it time you got off the sidelines and tackled trading? Join our online community of active traders where we make it happen every day. Stocks, options, futures, and Forex at www.tackletrading.com. Get in the game.